everyone, I'm happy to welcome you all for this presentation. So, in this presentation, I'm going to give you information about issue management. So, issue management refers to managing issues of corporate securities like equity shares, preference shares, debentures, and bonds. Just a minute, let me take a pen. Right, so equity shares, preferences, and debentures, and also bonds. So managing all these instruments is comes under issue management. So these are all the instruments of corporates in order to mobilize, in order to accumulate, in order to collect the funds. Right, so management of issues also involve other issues such as the decisions concerning size and time of public issue in the light of market condition are advised by merchant banker. So there is a high correlation between merchant bankers and issue management. So already you might have aware of it. So merchant bankers are one of the financial institution that will provide financial advisory services, portfolio management, and other business related services to the corporates. And further, issue management is also deals with bonus issue, rights issue, and a combination of these two. Right, so in brief, managing public issue is a complicated and technical job. It involves various strategic decisions and coordination of various agencies, right? So overall, issue management is managing all kinds of shares and debentures, bonds. So usually there are three kinds of issues, that is private issue, rights issue, and public issue. So most frequently we heard and we use this public issue. Public issue is issuing shares to the public, right? And rights issue is issue of shares to the existing shareholder. And private placement is issue of shares to the private other institutions, right? Let us see in detail about public issue. So it is the most common method of fundraising, right? So in this method, the funds are collected from the public through prospectus. Say prospectus is the document so which contains all the informations about the company and their fund information, their assets, liabilities, dividends, all information related to the shares are given in this document, and it is a document which will invite the public to make investment into the company. So that is the prospectus. Okay, so in public issue, the prospectus is released by the company. It gives all the information about the company, shares, everything, and it is approved by the apex institutions, that is Securities and Exchange Board of India. So as SEBI is the apex institution of the securities market, so that gives you the guidelines how to raise the funds and all. This prospectus follows all the guidelines and information given by the SEBI. So by adapting all the guidelines, the companies will release the prospectus. Through prospectus, they'll invite public to take part into their company. And coming to the rights issue, as I told you already, rights issue is issue of shares to existing shareholders, right? So they will not invite new investors to make funds, to raise the funds, whereas the issues are given to the existing shareholders. Usually the company issues shares to their employees. So most of the public companies, so they will give their shares, they will sell their shares to their employee, and in order to raise the fund, the preference will be given to their employees. And again, if they wants to make fund, the preference again will be given to their employees, right? So for example, if the share value, that is a face value is the minimum value of the share fixed by the company. So if the face value is 100 rupees, it may be offered at par value. So whereas while the market price of the share at the time of offer may be 15 or more. Okay. So in rights issue, the shares will be given to the existing shareholders with face value. And coming to the private placement, so it is the direct sale of securities by company to investors, right? So that is, it will not sell shares to the public, to the existing shareholders, whereas it is sale of securities by a company to the investor is called private placement. So in private placement, there won't be prospectus. So this is the main difference between public issue and private placement. So in public issue, prospectus is the main document. It will give you all the information about the company, share details, whereas in private placement, there is no prospectus are issued. And this private placement covers shares, preference shares, and debentures. It is assumed that the investors have sufficient knowledge and experience to be capable of evaluating the merits and risk of the investment. Okay, so that's why existing investment companies will take part into this private placement. And so the shares are issued in three methods, and there are different kinds of instruments are used to issue the shares, right? So the first one is equities, and debt securities, derivatives, exchange traded funds, foreign exchange instruments, and depository receipts, right? Equities. So equity securities refers to the part of ownership that is held by shareholders in company. So the main difference between equity holders and debt holders is that the former does not get regular payment, but they can profit from the capital gains by selling the stocks. And coming to the debt securities, there are different kinds of debt securities are there. First one is bonds. So bonds are fixed income instrument. So that is irrespective of the market fluctuation, bonds will give you the fixed income, right? So that is government bonds, state government bonds, municipality bonds. So these governments, irrespective of the market fluctuation, it gives you regular income. The thing is, there would be a lock-in period, whereas in equities and all, there is no lock-in period. At any time you can purchase and sell, whereas in bonds you cannot sell anytime. So after lock-in period only you can able to sell. And coming to the debentures are unsecured investment option. It's not like bonds, right? So the lending is based on the trust between two persons, right? So herein investors act as a potential creditors of an issuing institution or company, right? So this will not give you any guarantee, but based on the trust. Say for example, you may you can purchase the debentures of your own friend company in order to support your friend, so like that. So that could be an example for this debentures. And coming to the derivatives, it is one of the instrument of capital market. So already you might have aware of what is capital market and what is money market. So capital market is the long term or capital, it's a long term market, whereas in money market it's one of the short term market. So capital market, you can also call it as stock market, right? So in stock market there is another instrument that is called derivatives, and popularly equities or shares. That equities and derivatives comes under capital market. So equities also can be called as shares, whereas derivatives is something differ from equities, right? So it has different options, that is forward, future, options, and swapping. So forward is a contract between two parties in which the exchange occurs at end of the contract at a particular price. So that is the forward. Whereas future is a derivative transaction that involves the exchange of derivatives on the determined future date. Say for example, today I sell my product or service or anything, right? So in future date. So today I fix the price. So what could be the price of turmeric in the next month? So that contract will be raised today for future transaction, that is the future. And option, it is an agreement between two parties in which buyer has the right to purchase or sell particular number of derivatives at a particular price for a particular period of time. Say for example, I agree to purchase 100 quintal of turmeric in the month of July. So like that. So that is the options. And interest rate swap. So it is an agreement between again two parties which involves the swapping of interest rate, where both the parties agrees to pay each other interest rate on their loans in different currencies options, that is called swaps. And exchange traded funds. This is the pool of financial resources of many investors which are used to buy different capital market instruments such as shares, debentures, and bonds, derivatives. And coming to foreign exchange instrument. Foreign exchange instruments are financial instruments represented on foreign market. So that is the market of other nation. So it is mainly consist of agreements and derivatives. So based on the currency agreements that you can broken into different categories, that is spot, outright forwards, and currency swaps, right? So we'll just see what is spot, outright forwards, and currency swaps in the next video. Thank you for watching. Thank you.